IVM.
Welcome to another week on IVM. It's been a great week, and if you aren't following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. On Geek Fruit this week, Tejas and Dinkar discuss their favorite movie soundtracks. On The Scene and the Unseen, Amit Verma talks to researcher and activist Amit Chandra, and they dissect India's education sector. On Cyrus Says, we have writer and director Anand Sivakumar, who's hosting a great new show for us called Croc Tales as well. Anand and Cyrus talk about how Anand journeyed from an engineer to a full-time writer. On Simplified, Naren, Chuck, and Shriketh go to the root of the word assassin and twisted an interesting history behind it. This week on Shunyan, we're joined by Sanjay Nath, who is the co-founder and managing partner at Bloom Ventures. We have a really interesting conversation about investing. On Marbles Lost and Found, Zen and Avanti talk to psychotherapist Alicia Halani. And also this week marks the 50th episode of the Pragati podcast. Hosts Hamsini Hariharan and Pawan Srinath sit down to talk about the long, strange trip it's been and also round up some of the recent news. And with that, I'm going to take you on to your shows.
Folks, welcome to Paisa, Vaisa, your podcast about personal finance. And this is the second of our three-part series on fixed income. I have in me R Sivakumar, head fixed income at Kotak Mutual Fund, and Lakshmi Iyer, who's the CIO debt and head product at Kotak Mutual Fund. In the first of our three-part series, we were talking about what exactly is fixed income, some terms and concepts in that. In this second of our three-part series, we are going to talk about fixed income instruments. Siva, Lakshmi, welcome back to the show. Thanks for explaining these concepts to our listeners. Let's get into this, okay? What's the range, rough range, approximate range, and types of fixed income instruments? Okay, the one that's most familiar to all of us is fixed deposit, and I can see Siva pointing to Lakshmi also because she is the head product at Kotak Mutual Fund. Lakshmi, over to you. Tell us about this entire range of fixed income products from a retail perspective. Okay, I'm guessing because corporates have far more options than a retail guy. But for our listeners, okay, what's the range of these fixed income products?
And so there are two ways you can avail of fixed income products. One is through mutual funds, which I'll come to in a bit. Yeah. But apart from that, apart from the fixed deposits, which is very, very popular, and I call it the pull strategy. Everything else is push strategy, to be very honest. There is the tax-free bonds, which is the closest and have, high, I would say, affinity with the retail fraternity. Then is the...
1 minute. Tax-free bonds are not issued, they're issued only a few times in a year.
Yeah.
So you have two options to buy them. One is when an issue actually opens.
That's right.
Which I don't think has happened for some time, right?
Not
for some
now.
reason.
Not now, yeah.
And the second is through the open market.
Secondary market.
You can basically call your broker and tell them ki mujhe, whatever, Bilkul. 10, 20 IRFC ke tax-free bond de do. So
Bilkul. Bilkul.
Great.
But so both the options are available right now largely through secondary market.
Okay.
Then you have these public issues like how you have IPOs and equities. You also have similar kind of concept where corporates who want to borrow money through public, which is retail investors, announce their public issues.
Okay.
So these are called public issue of corporate bonds.
Okay.
Like recently we saw Edelweiss, we saw Diwan Housing, we saw JM Financial. So these are some of the examples.
These could be NCDs or bonds. The terminology doesn't really change.
Yeah, these are they call non-convertible debentures, which means that they're not convertible to equity. So this is completely fixed income.
Okay, but they're tradable, so you can easily buy and sell them.
You can not really easily buy and sell them.
Depends on the size and liquidity.
Depends on the liquidity. Usually you have to assume that these are like Abhimanyu. Chakravyuh mein ek baar gaye to phas gaye, nikal nahi sakte. So you have to be assuming.
Dangerous?
You have to assume that liquidity is locked.
Okay.
It sounds dangerous, but it doesn't mean you're going to go in there and die.
No, you're not going to go there and die. That was not the reason of the analogy. You assume that for liquidity, it's not available.
I think it's more Hotel California.
Okay. Let me put it this way. For an IPO, equity IPO, a lot of the people play it for the flip. You buy it at 100 and on opening day, boom, it opens at 120.
Yeah.
You can't do that in...
Not at all. You can't do that. Some people tried to do that with a couple of InvITs. It just boomeranged. So you can't do that. But these are largely predictable sources of cash flow where you know that, I don't need money for 3 years. Okay. I don't need money for 5 years. Okay. So these are the typical retail instruments which are available.
Fixed deposit.
Fixed deposits.
Tax-free bonds.
Tax-free bonds.
And corporate
debentures or NCDs.
Debentures could be bonds, whatever.
That's correct.
Things, okay?
For mutual funds.
Yes.
Pretty much we have access to these kind of instruments which we participate as institutional investors. Additionally, we also participate in money market instruments like typically commercial papers. Again, these are short maturity instruments issued by these same corporates.
Correct, fair
up to 1 year. Or these same things are called certificate of deposits when they're issued by banks. We again invest in treasury bills, government securities. Again, retail investors can also invest in government securities like they do in corporate bonds. So these are the entire suite of options available for us. But when the retail investor comes into a fixed income mutual fund, and as I mentioned in the previous section, they can invest in a liquid fund. Now with this recategorization which SEBI has announced, there is this entire more than a dozen of fixed income categories ranging from liquid funds at the shortest end to the highest end being a long duration fund, where you have to maintain a minimum maturity of at least 7 years. And within that you have pretty much, you ask for whatever genre. You ask for a toast with sugar, toast with butter, toast with cheese, and with toppings. All of that is available through money market, short term, long term, mid term, all of them.
Kind of like a mid cap and small cap mutual fund.
Absolutely. And as I said, the underlying investments across these is pretty much a combination of either or all of these instruments in various proportions.
Right, folks. So you want to just check up within your mutual fund what products are there on the debt side. Siva, Lakshmi mentioned the retail buying G-Secs. Government securities, which are shortened to G-Secs. Believe me, it just means that, GSEC. Don't go thinking. How can the retail do that? And, I thought that used to be an institutional market. That me as someone can't just generally pick up the phone and tell my broker, yaar, government ka issue aa raha hai, mujhe saw whatever. They issue bonds, is it? Whatever, yeah. What is this concept?
Retail, the government and the RBI have been trying their hardest to ensure a large retail participation in the government securities market and failing at it for the last couple of decades. So I think while it is perfectly possible, the number of hoops you need to jump through. I think about 5 or 6 years ago, one of my colleagues tried to do that to buy G6 in his Demat account and thoroughly failed. So I think it's a very difficult market to access. And then another very important segment of the market. More than 90% of the capital raised by companies in India through fixed income instruments happens on what's called private placement basis, which means they are not open in a public issue. So they're privately placed, are only available to institutional investors like mutual funds or insurance companies and banks and so on and so forth. So if you as a retail investor really want to participate in this market, and this is by the way 95 to 99% of the market, that is government securities and privately placed corporate bonds, the only real way is something like a mutual fund.
Folks, I just want to add into that. You have a 10-year bond. And I'm sure that the government issues a new bond each and every year. That's why it's called the 10-year bond. It can't, be the same for throughout. So what Siva said is that when the government issues these bonds, it's easier for institutions like banks, NBFCs, insurance companies, and a whole lot of other people to buy them. You can also buy them, honestly, but it might be easier for you to buy, say, a corporate NCD through your broker than it is to buy a G-Sec?
Absolutely. And I think one is there is a lot more established demat process for corporate bonds as compared to G-Secs. And G-Secs, the dematerialization process itself is you need to get a demat account in a G-Sec itself, you need to jump.
I can't use my same
you can, but it's a lot more complicated. So, it's not easy. That's the reason why it has not really taken off. The other thing is it's very illiquid. Let's take any company, XYZ Limited. It has one equity share. But the same company may have 20 or 50 different bonds out there. So when you look at the liquidity of that equity share, the entire liquidity, everybody who wants to trade XYZ Limited are going to just buy and sell that one equity share. So therefore, there is a natural cluster around that liquidity. If there are 50 bonds and the liquidity is now split across those 50 bonds, you can imagine that is a lot less liquid. So which is the reason why we say that, if you really want to get into corporate bonds or etc., it's probably much easier to do it in a mutual fund than to directly try and buy and sell bonds yourself.
Okay, fantastic. Last question on this segment, Lakshmi, for us, I'm saying us because I'm an equities guy, we've got quarterly results. Once every quarter, the company comes and says, this is my quarterly result, etc., etc. I believe the closest equivalent for the fixed income market is something called the RBI policy. What is the RBI policy and how does it work? And why is it important for fixed income?
Okay, so yes, from a macro perspective, what you said is absolutely right. While we also do track quarterly results for our credit portfolios, where we buy these corporate bonds. But yes, from a macro policy setting perspective, there is a 6-member team which is led by the RBI Governor, Dr. Urjit Patel, right now, which meets 6 times in a year. It is a 2-day meeting followed by the outcome, where these 6 members of 3 from the government, deputed, and 3 from the RBI, they meet together to discuss the various macro variables like inflation, retail inflation, how much has it impacted people like you and me, what has happened to interest rates globally, is there a lot of people demanding and chasing a lot of goods, and therefore the perception, how is the monsoon, barsat ka man kaisa, is it going to be flooded in Khar today or in Bandra elsewhere?
It was,
yeah, so something of that sort, and I'm trying to make it as colloquial as possible, but something like this, and of course, what are the other central bankers going to do? How is the government going to behave if crude oil were to jump out of the window at $100, or if it comes crash landing to 30. So, various of these policies, issues which are plaguing the country at a particular juncture are discussed over those 2 days.
And the sum result of
and
everything.
The sum result of that.
Those 2 rates. I need to explain this in the most simplest of language. Even I don't know. Repo rate and reverse. Ek to repo itself means repurchase. Now how can, so reverse repurchase means purchase, is it? Okay, jokes apart. Repo rate, reverse repo rate.
So that is the benchmark rate of the country, the rate based on which every other rate is actually set.
Okay.
Which means a bank's lending rate, or a corporate's lending rate, or his borrowing rate, or the entire ecosystem in a banking. Like in US, and more of even the retail investors in India have heard of this concept called US federal funds rate.
Correct. Yeah.
So that is the benchmark rate. Okay. So if you as a banker, me as a banker, and we're all bankers in this room, for example, and we all need to borrow money. We also need money, right? So if we need money from the Reserve Bank of India, who is known as a lender of the last resort, we go to him, he gives you money at that rate.
Okay.
And obviously he has to make some profit.
Yes, he does.
Okay, not that is his intent. But if you have to lend money to him,
right,
you lend to him at the reverse repo rate. It's as simple as that. And therefore, the reverse repo rate is always lower than the repo rate.
Okay.
This is the only simplest definition. You can get into more complex ones. But I think for our audience, I think this is good enough to understand.
Yes.
So any, I would say, banker, any corporate, any market participant like any of us who want to base our decisions of buying, selling. I want to buy a house. Okay. So I will see if I want to borrow it from XYZ bank. That bank will also decide its rate based on where the repo rate is.
Correct,
they can put a spread of whatever they feel it is, and there are other measures to monitor that.
Right.
So that's why the RBI MPC, or the Monetary Policy Committee resolution, is very, very important.
Okay.
Not only for the bond markets, also for the equity markets, but largely for the bond markets.
If you're a retail investor who's invested in debt mutual funds, honestly, you shouldn't really be swayed away with all this monetary policy mein kya ho raha and all that. I mean, if you're invested, say, for the longer term in a 3-year product, then these things really don't matter, do they?
Absolutely. I think we love to show up the volatility or show up a lot of these news items. We just love to discuss it. But reality is the impact over the long term is very minimal. So, if you buy a 3-year bond and because of RBI policy that bonds price went up or down for the first year. So what? At the end of 3 years, you're going to get your money back. How does it matter? So I think the point is that if you hold long enough, these risks you just sort of bypass them or walk past them. But I think it's something that for us as professionals in the industry, we care a lot about this, because this gives us an opportunity to trade bonds and make a profit out of it. If we get very good at understanding what RBI will do, so let's say if we believe that RBI will raise interest rates, I might sell bonds. As we discussed earlier, if interest rates go up, value of the bond comes down.
Correct.
So if I anticipate rising interest rates, I can sell my bonds ahead of that and then buy them back at a lower price after the rate goes up. So inside the industry, for us, we live and breathe with policy decisions of the RBI or the budget or the US Federal Reserve, etc., etc. But I think for most people, it genuinely doesn't matter, and I think it's nice to talk about it.
Absolutely.
Fantastic, folks. That's a wrap on segment 2 for our fixed income special with R Sivakumar, head fixed income at Axis Mutual Fund, and Lakshmi Iyer, CIO debt and head products at Kotak Mutual Fund. Sorry about that. Stay tuned for the third and final episode in this 3-part series.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Did I just catch you on your way to work? Or did you end up pulling an all-nighter? Let me guess. You have a packed schedule for the day, the week, and probably the month and the year. That's a lot for your mind to handle, don't you think? This buzzing chaos also brings tons of negative thoughts. Am I right? Try spinning that bottle in a positive direction with me, Chetna, on the Positively Unlimited podcast, every Monday on IBM Podcasts. It's time to change your life one alphabet at a time.